Good afternoon. You're with us here on Halftime Report on CNBC TV18. I'm Hormuz Patakia. With me is Mangalam Malu. Before we get to the markets, the big number flashing at the bottom of your screen, the WPI numbers for the month of November at 1.89% compared to 2.36% in the month of November. The food inflation has cooled down month on month but continues to remain on the higher side as well, right? 9% compared to almost 12% last month, but still a cool off on a month-on-month basis nonetheless. The CNBC TV18 poll had projected the figure at 2.3%. Mangalam, good afternoon. The numbers look slightly good on a month-on-month basis.
The numbers look slightly good on a month-on-month basis, but the stickiness of the food inflation is something that we'll most definitely keep an eye out on. Obviously, we do have the November CPI data as well, so WPI is just, slightly lower than what the street was anticipating. 2.3% was the poll, and the numbers come in just shy of that 2% mark. Month-on-month, it's cooled off from 2.36% to 1.89% as well. What's actually aided this reduction in WPI month-on-month is fuel and power. That has come down by 5.8%. So there is a disinflation of 5.8% in food and power, which is fuel and power. That is down from negative 5.79% in the previous month to about negative 5.8%. We have seen primary articles inflation that has too cooled off from 8.09% in October to about 5%, 5.5% that we're seeing right now. The food inflation, it's still sticky at around 8.92% compares with around 11.59%. It's shown signs of moderation, but still at a higher level. And then we also have, the core inflation that has come by. So we'll keep an eye out on all these things. We do have Aditi Nayar, who is Chief Economist at ICRA, joining in now. Aditi, there has been some moderation month on month, but there is still some stickiness when it comes to the food part of inflation. What do you make of these numbers, and what's your view in the very near term?
Thank you. We had actually expected the WPI inflation to come in at around 2% in this month, so it's come in just a tad below what we were expecting. And the broad theme for November was that a favorable base effect was going to pull down the food inflation in this month. Now, looking ahead, there's a couple of things that we need to watch out for. The month-on-month momentum for food items is really quite mixed right now, and we're not going to have such a favorable base effect going ahead. So that's kind of juxtaposed with the fact that we've got the Kharif arrivals coming in, and overall the Rabi outlook is looking reasonably favorable at this point in time. So we're hopeful that we're going to end up with a good Rabi crop as well. On commodities, the disinflation is expected to narrow going ahead, and that is something that is going to feed into many parts of the WPI. So that's something to watch out for. And the INR has also been depreciating. So again, that's something that typically transmits a lot faster into the WPI than into the CPI. So that's the other theme that we need to keep an eye on. Overall, for the month of December, we would actually expect that we're going to have a little bit of a reversal. So we're looking at a higher WPI inflation of around 2.5 to 3% for the month of December.
Aditi, good afternoon. Thank you for joining in. Would food inflation be a primary contributor to that reversal? Because month on month, the numbers may have cooled off optically, but they still remain higher, right, at that 9% level. Do you see this winter crop coming in and all of these factors contributing to a decline in food prices and then subsequently food inflation, or do you see that number remaining on the higher side again?
So we do expect the YOY food inflation number to remain quite high in December, even though on a month-on-month basis with the winter crop, etc., we do expect to see some amount of softening. But we're not expecting it to be as much as what was the case last year. So between November and December last year, we had a sharper sequential easing, and that's not something that we're expecting this time around, in spite of the fact that some easing, which is typical seasonal, decline would be there. And overall, the trend is also quite mixed across different commodities. So we still need to keep our eye on edible oils, for instance, and even in the vegetable pack, we are looking at a normal seasonal easing in some of the winter vegetables, but for potatoes, onions and tomatoes, I think we still need to be a little more watchful given the amount of volatility that we've seen in the recent months.
All right, we take that point. Aditi, just a final question before we let you go. Your view on the RBI policy, when does the first rate cut come in?
So, generally our view has been that if we get another step down in the CPI inflation to around 5% or so in the next print, which will be the last print that we will have before we go into the February policy meeting, then the likelihood of a rate cut would probably be quite high. So really, how much of a step down can we get between the November and the December CPI inflation reading? That's the main thing that we're watching out for. On the growth side, we won't have another quarterly print, but we will have the advanced estimate for the GDP growth that will be available in January. And our sense is that Q2 was probably the bottom for the GDP growth. We do expect to see higher numbers for Q3 and Q4. So mainly the decision will rest upon what is the kind of downtrend we see in the CPI inflation. And do we see more confirmation that path down to 4% that we had seen outlined by the MPC in the December policy review? Are there any fresh risks that seem to upset that disinflation down to 4%? Or does the December print suggest that we're on track to meet that?
A little early to talk about this, but even the budget, right? We have Feb 1, the union budget. What would be the policies from the fiscal end is something we'll keep an eye out on, especially given the slowdown that we've seen in GDP growth. Would you be worried about that?
So a few things that we'll be looking out for in the budget for the monetary policy cues. One, of course, do we get that 4.5% fiscal deficit target for next year that we're expecting? Of course, what is the revised estimate for this year, and then how much further correction in the fiscal deficit is envisioned by the government for FY26. What are the medium-term cues as well? Because we are looking forward now to the fresh medium-term path, which was suggested by the government in the last budget that they're going to move to looking at debt to GDP instead of fiscal deficit to GDP as the indicator for the fresh medium term. So more details around how that is expected. And then for FY26 itself, within the overall fiscal deficit target, what kind of expenditure growth are we looking at? What is the quality of expenditure? For instance, this year, the sense we have is that capex is going to undershoot the target, maybe by as much as 1 trillion, because the early trends that we have up to the last month are not suggesting that there was a very sharp upturn, in capex after July. So if you recall, in the first quarter because of the elections, capex was moving quite slowly. We got a big surge in July, and then the momentum has varied quite a lot in the subsequent 3 months. But of course, the last month for which we have data is October, which was the Diwali month. So how much of a big push are we going to get between November and March? We are expecting the YOY growth to be very high, but we still think that capex will fall short of Government of India's target for FY25. So on top of that, what kind of a YOY growth are we looking at for FY26? That will also be important both to understand the fiscal impulse for growth and the overall quality of expenditure.
All right, Aditi, thank you so much for sparing time and joining us to decode the WPI numbers and the road ahead as well. That is Aditi Nayar of ICRA, the November WPI at 1.89% below the CNBC TV18 poll. So before we slip into a break,